Hello. So, welcome to today's session. And today we are going to see the ways to generate regular income from your investments. So, it's been some sessions that we were talking about investments. So, now we will see how you're going to make regular income from your investments. So, many individuals basically assume, in fact, mistakenly believe that investments are only for a long-term gains, right? So, because we always talk about compounding, reinvesting, and everything, so it is believed, or is it? It is misunderstood, or it is mistakenly believed that it is, only for long-term gains. But, that's not the case. Actually, you can get some, returns also, and you can generate consistent income also from the investments, and that's exactly what I'll be discussing in this session. See, you know, the thing is that it is possible, okay, and it is possible to structure your investment in such a way that it can provide steady income stream now also. So let's look at five different methods that can help you to achieve this. So I'll be discussing five different ways in which you can make consistent regular incomes from your investment. Okay, so see first, if you have some good knowledge about stock market and trading, you can pledge your mutual funds or stocks, and then you can make some small incomes from option selling. But I'm not including that here because that involves certain risk. So I'm not talking about that. I'm only talking about something which is incoming. I'm not at all interested in something which is having a possibility of outgoing. Okay, so here we will only talk about some income. Okay, so let's start with the fixed deposit. A conservative approach. See, fixed deposits are one of the most commonly known options for generating regular income. By investing your money in bank FD, you receive interest upon that, and that typically range from 6 to 7%. And this income is stable, and your principal remains safe also. But FDs, do not outpace inflation. The problem here is inflation, especially after tax. Sorry, guys. You get, let's say you get 7% or it's 6% or whatever. uh, Post tax, whatever you get, that is what the nominal interest. It's not the real interest. Real interest is something which need to be adjusted with inflation. So if inflation is more than what you're getting, then effectively you are having a negative interest rate in interest actually there. So let's say you're getting 6%, even let's say post tax, and let's say inflation is 8%. So 6 minus 8 minus 2, that means you lost money here. So that's the issue here. And this means the real value of money is actually decreased over a period of time. So for younger investors, relying solely on FD may not be an optimal strategy. In fact, I'll never recommend if you are, a younger investor, because by the time you grow up, and there are a lot of potential options which are available to you. But for safer investors, like if you are above 50, then FD should be part of your portfolio. Coming to SWP, very popular these days now. Okay, systematic withdrawal plans. Another popular option, which is a systematic withdrawal plan, similar to SIP, but it's reverse. See, with SWP, what you do is you can withdraw a fixed amount regularly from your mutual fund investments. But this approach comes with the risk of market volatility. If you need to withdraw funds during a market downturn, then you need to sell more units. Okay, so I hope you understood. Mutual funds are based on NAV. NAVs have certain value, one unit. So you need to sell more units if you need to get that, particular income at that point of time. If you are withdrawing during a market crash, and which can deplete your investment faster, and at the same time that can impact on the compounding aspect also. Therefore, you know, SWPs provide that flexibility, but they require careful consideration of market conditions also. Now, the next one. So sorry, missed it, right? Yeah, you will be setting the withdrawal amount. So you need to sell more unit if it is during a crash. Uh, yeah, okay. Now coming to the real estate and rental incomes. See, guys, again, investing in real estate can be an excellent way to generate a regular rental income. You keep on getting rents. See, it's not that you are simply investing on a piece of land. That will only give you capital, appreciation. The property, that you bought, it will appreciate, and later you will get money. Otherwise, a plain land is not going to give you anything. But if you are investing something where you get rental income, that is something which is really good, especially if you get some 4-5%. 3-4% is also very good, because FDs are giving you like 6% here. Rent you are getting 4%, and then capital appreciation is also there. If you are putting in FD the same amount plus interest you are getting, here you are getting the capital appreciation, right? And at the same time, the interest or the rent also. That's something which is very good. So that's a very decent investment. So that's again our regular income flow which you can get. See, whether through residential or commercial properties, make sure that you get rent if you're investing in real estate. Otherwise, if you're investing in a plain land, make sure that you will be able to sell at a higher price later, and you're investing it for the future. You're not going to expect anything during this period. So real estate basically give you rental yields and also property appreciation. That's what make it beautiful, and it can outpace inflation. So when inflation is there, the property will keep on growing. At the same time, you keep on getting rent. So that's why real estate is one of the best, and you can get loan also for that if you want to. Okay, so for that we need to take separate discussion. I have invested, in fact, very good in real estate, and almost all with the loans. See, the real estate again requires significant upfront capital. That is what mistakenly many people believe. But you can manage it with the loans also if you manage it properly and carefully with rent and returns and all those things. Now, as of now, I'm talking conservative. If you have upfront capital, then you are investing. You are like instead of fixed deposit, you are investing in the real estate, and for the rent, that's what you're actually doing. Okay, so I'm conservative here. I'm just before when I start the session itself, I've told you I'm not talking even about trading or something which you can bring from option selling, which can be a regular income. I'm not talking about that. Again, I'm not talking about loan here when it comes to real estate. So only upfront capital. So that involve, ongoing management, maintenance, and all those issues are there. And for those with enough funds, this can be a reliable, very good income source, but it may not be feasible for everyone because you need that upfront capital. Now coming to REIT, which many are asking about. See, if direct real estate investment is beyond your budget, okay, real estate investment trust offer an alternative. What you're doing is by purchasing REIT shares, you invest in a pool of income generating properties, which are managed by professionals. So you are investing here. You're buying a share means you are investing in some income generating properties, and which are managed by the professionals. So REITs provide dividend based on the rental income and acquire much less capital than buying property. So for example, if you need to buy a property, you need 1 CR. So you are investing whatever you have in REIT by buying the share. So they are buying property, they pool money from different people, and whatever rental income that they are getting, that will be given as dividend. Same as like stocks. Okay, so but the REIT do not offer the capital appreciation benefits of direct property ownership. That's a disadvantage. You get the dividend, you get the rental advantage and everything, but you won't get the capital appreciation. But what's the real beauty of real estate? The real beauty of real estate, how wealth is made from real estate. It is from capital appreciation. It is not from the rent, right? So that's again something which you need to understand. That's the main difference. Coming to bonds, there's a middle ground. Okay, so bonds are safer investment option that generally offer returns higher than FDs. Government bonds I'm talking about, or companies bonds also, corporate bonds also. Companies issue bonds to raise funds. So and investors receive the fixed interest rate over the bond term. So in bond, let's say it will be mentioned, let's say 100. You'll be getting a bond of 100. So by the time of purchasing the bond, you'll be paying something like 90. And upon maturity, you'll be getting 100. So what is that return? Return is around 10%. That's how the bond work. Okay. So companies issue bond for what? For raising fund for them. Instead of borrowing from banks, they can get fund from you, and you'll get that fixed return also. So bonds again provide a guaranteed return. Whatever is mentioned in the bond, that 100, that you will be getting. And what is the return in that? Return in that is the difference between what you pay to purchase the bond and what you get after maturity. So that is again making a stable source of income. But investing in corporate bonds, that carries some risk. as a company's ability to repay the principal depends on the financial health of the company. So again, you need some kind of careful research, and selecting bonds from reputable companies are crucial to minimize the risk. But government bonds is always anyway safe. Now, coming to platforms for safe bond options. See, platforms like Wint Wealth and GoldenPi allow you to explore and invest in bonds with fixed returns ranging from 9 to 11%, which is decent, more than FD, and safety is also there. Liquidity, again, there is a problem. You need to wait for the maturity. So some bonds distribute interest regularly, providing, periodic income. So from that, you can get periodic income as well. There are certain bonds that you need to refer and research. See, before investing, check the bond's credit rating, AA, like that, or higher is preferable for lower risk. Better rating is what more preferred, that is having lower risk. So this approach ensures steady income. I told you can get regular income, or you can get income based on the maturity also, and also you get safety and return. See, what are the three criteria? You are looking for safety, you are looking for return, and you are looking for liquidity. So here you have the safety and you have moderate return also, no issue. But issues with maturity, liquidity. You cannot immediately claim that, right? Maturity is there. So now peer-to-peer lending. See here, P2P lending platforms, they offer fixed returns by connecting investors with borrowers, direct, investors and borrowers. While these platforms claim attractive returns like 12% per annum, 15% per annum, etc., they again involve higher risk. So you need to ensure that you understand the way the platform operates, the collateral policies when you are, getting connected, and what happens in case if borrower default, who will take up the responsibility and all those things. But I never recommend this anyway. P2P lending should only be part of diversified strategy and approached cautiously, because you are getting good return. So I already told about diversification. So if you want to diversify into different instruments, maybe 1% you can do here because of the return that you're actually getting. So look at the collateral and other things, and then you can go for it. Then other option, emergency funds and investment balance. Yes. See, while exploring these options, always remember to maintain an emergency fund. That is something which is very important. 6-month expense, irrespective of any situations, you are not working, you're not getting any income. Still, you should be in a position to live the same standard of life for the next 6 months. How much is required for that? Manage and maintain it as an emergency fund. So FDs are suitable for emergency savings due to their safety and liquidity. But for investment purpose, you can prioritize options that outpace inflation and offer consistent returns. Diversify your investment to strike a balance between short-term income, long-term growth. We have discussed already about the goals, short-term goals, long-term goals, mid-term goals, right? So based on that, you need to diversify your investment and your strategies. Now let's conclude this discussion. So guys, again, to sum up, generating regular income from investment require a mix of strategies which suit you, your risk tolerance, and your financial goals. So you need to define your financial goals clearly, and you need to understand your risk tolerance, which is based upon multiple criteria, your age and everything, your income and all those things. So there are multiple options which I've discussed. It ranges from stability, like FD and bonds, to the potential higher returns of real estate, REIT. Each choice has its own pros and cons. So understand them and align them with your financial strategy and your understanding. That is very essential. And if you have any questions, or if you need any clarification, or if you need any support, you can get in touch with me, and you can mention that in the comments also. So, or directly you can get in touch with us, and see you guys in the next session. Thank you so much. Thank you for watching the video.